Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two beaten down S&P 500 giants from very different industries that have also been hard hit this year to consider possibly buying heading into 2024. And those two stocks are NextEra Energy and Pepsi. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two stocks, I just want to quickly go over the broader market at the moment. I'm recording this on Thursday afternoon, right before the long Christmas holiday weekend. So the market finally took a pretty much deserved breather on Wednesday following that scorching rally. There was little doubt that plenty of stocks had been pretty overheated after the run that began at the end of October, kind of got sent into overdrive following that Fed's dovish turn. Stocks then ripped higher, though, through early afternoon trading on Thursday, heading into the official Santa Claus rally period in the next few days. So Wall Street could no doubt experience either some more selling or in the near term or buying. You never know in the next few days or few weeks. But obviously a pullback seems in line at some point to trend back down to some longer term moving averages, just because we've been on such a huge run, though the overall bullishness seems to be thankfully in place. So lower interest rates and the expectation of the Fed cutting again or starting to cut in 2024 kind of changes the math on cash and bonds. So you'll see more people kind of positioning themselves to be on the right side of a possible extended rally in 2024, especially if anyone missed out on this big 2023 we had. Since this time last year, a few people were calling for a big rally. And it's also worth noting that the recent rally, especially in December, has featured nearly every corner of the market and not just mega cap tech stocks. So that's a great sign heading into the new year. So investors might want to consider buying stocks outside of technology. And in fact, it might be time to start looking at some big beaten down names from hard hit industries this year. And the two stocks we're looking at today are been hit hard. They're both still in the S&P 500 and been in the red, firmly in the red this year. And they're part of industries that have been hard hit so far. So the consumer staples sector, which is where Pepsi is part of, is down 4.5% overall in 2023, with energy, which is where NextEra Energy is part of, is down 4% this year, even though the S&P 500 is up over 22%. So obviously things go in cycles, and it might be time to consider, as I said, getting into some of these beaten down industries, especially as everything's kind of catching buyers over the last month heading into 2024. So the first stock up, as I said, is NextEra Energy, which trades in the ticker NEE. NextEra Energy operates one of the largest electric utilities in the U.S., which is Florida Power and Light, and it's one of the biggest producers of wind and solar energy in the country and the world. It's also got a battery storage segment, and it's exposed to the potential long-term upside of nuclear power. The $120 billion market cap firm is also the largest holding in the broader utility sector SPDR ETF, which is that XLU. So it's still a giant of an industry that's obviously been hit hard, as I said. So I said it's energy, but it's energy and utilities have been hit even harder. Utility sector is down about 12% this year. NextEra went on an extended decade-plus long run as it expanded its reach and invested heavily in non-fossil fuel-based growth. The firm then kind of got crushed in 2023 as higher rates slowed the expansion of these CapEx-heavy investment projects such as solar and wind. So overall, the stock is still up about 375% in the last 15 years. This outpaces the utility sector, which is up about 40%. Yet it's down 35% from its peaks, and it plummeted once again in late September of 2023. It fell after its subsidiary, which is NextEra Energy Partners, which trades the ticker NEP, slashed its distribution, so its dividend growth outlook to between 5 and 8% per year through at least 2026 versus its 12% target. They said at the time to, quote, increase its flexibility as it continues to execute on its growth opportunities. Separately, though, NextEra Energy said around that time that it was going to sell Florida City Gas to Chesapeake Utilities for about 900 plus million in cash to continue, quote, its strategy of redeploying capital into our core businesses. Though everyone was worried that NextEra Energy Partners slashing its dividend growth outlook didn't actually happen for NextEra Energy. It reaffirmed its long-term outlook at the time, which includes its dividend per share growth rate of roughly 10% per year through at least 2024 off a base of 2022. And if we look at the overall growth outlook for the company this year, we're calling for 31% revenue growth to get all the way up to $27.5 billion and another 4% growth next year. And then on the bottom line, we're calling for about 8% growth in 2023 in terms of adjusted earnings, and then another 9% adjusted earnings growth next year for NextEra Energy. So solid top and bottom line growth. And the company has topped our estimates by an average of about 7% in the trailing 4 quarters, including a 9% beat last quarter. And its earnings revisions activity helps it land a Zacks rank number 2 buy at the moment. And its dividend currently yields about 3.1%, and it's raised its payout by an average of 11% annually over the past 5 years. We should also note that it's one of roughly 65 S&P 500 dividend aristocrats, which are those firms that have both paid and raised a dividend for at least 25 straight years. And then in terms of brokerage coverage, 10 of the 15 brokerage recommendations Zacks has are strong buys with only 1 sell. So this is despite all of this beating it's taken so far this year. It's now trading around where it was in the early part of 2020, and the stock is up about 16% since early October, with it back above its 50-day moving average. That said, it's still trading under its 200-day moving average, and it's also still trading below its 200-week and 50-week moving averages, as well as its 50-month. So these key longer moving averages, it's still below those levels. That said, it remains at its most oversold or near its most oversold RSI levels in terms of on this longer term time span since 2009. So if you're looking to possibly get in based on some technical levels, it might be a little risky for some to consider when it's still trading below its 200-week and 50-week and 50-month, but it's trending back in the right direction. It's back above its 50-day, and it's still at these really heavily oversold levels over a 15-year time scale, when the broader market and a lot of the tech sector is actually trading at rather overbought levels. So might be worth considering on that basis. And then on the valuation front, NextEra is trading at a 50% discount to its own highs and below its 15-year median at about 17.7 times forward 12-month earnings. In the recent bounce actually saw it climb above. It was trading at its lowest levels over the last 10 years until early October, when it started to catch some more buyers. So overall, NextEra is certainly worth considering at the moment, especially when utilities and energy has been so hard hit, and everyone's nervous that these higher rates are going to hit places like solar and wind. But things are always changing, and now that rates are stabilizing and coming down, that could benefit NextEra in the broader space. And it is worth noting, as just a disclosure, I own NextEra in my personal portfolio. Now we're going to move on to PepsiCo. So it's not just Pepsi, it's PepsiCo. As I said up top, it trades under the ticker PEP. So Pepsi is the firm behind, obviously, Pepsi, Gatorade, Frito-Lay's, tons of other consumer packaged goods, from so drinks and various snacks and that. So it makes the food and beverages or everyday consumer items that people snack on all the time and eat and drink. And that whole sector of the market has been hit pretty hard. One of the main concerns this year, especially over the last 6 months, has been the consumers are kind of just exhausted by the constant price increases and are starting to cut back, which obviously hurts companies like Pepsi and the broader consumer staples market. Another factor weighing on that is that the rise in interest rates reduced kind of the traditional aspect of consumer staples, which were dividend players. That obviously hurt NextEra as well. So as you could put your money in a money market fund and get 4 to 5% risk-free returns, the dividends of NextEra and Pepsi look a little less impressive. But as rates are coming back down, these dividends will look better going forward. On top of that, there's been growing worries that weight loss drugs like Ozempic are going to hurt Pepsi and other companies that sell soda and snacks and things like that. But Pepsi topped our estimates last quarter and it provided upbeat guidance. So we're calling for about 6.5% revenue growth this year, and then another 4.5% revenue growth next year. And then we're calling for 11% adjusted earnings growth this year, and then about 8% adjusted earnings growth next year. So that doesn't tell any story of a total fall off in demand because everyone's taking Ozempic and not snacking anymore. That might be happening on the margins, but it's certainly not happening overnight and not anytime soon. And overall, it's positive earnings revisions helping land a Zacks rank number 2 buy. In some of the growth outlook we're calling for kind of falls in line with some of the recent growth and actually comes on top of some really impressive growth in 2022 and 2021 in terms of Pepsi's ability to expand its top line. In terms of brokerage recommendations, 7 of the 16 brokerage recommendations that we have are coming in at strong buys next to 9 holds, so no sells in there. And then when we look at its dividend, it's yielding about 3.1% at the moment. And now taking a look at its stock price performance, the stock's up about 100% over the last 10 years versus the consumer staples sector, which is up just 10%, and the benchmark, which is up 160%. So it's obviously lagged the S&P 500, but well above the consumer staples sector. It's also up about 260% in the last 20 years versus the consumer staples sector's 75% growth. Pepsi is up about 15% in the last 3 years. In fact, it was actually soaring in the early months of 2023, but it's actually down now 16% from its highs from earlier this year, back in May. And it's also trading around 15% below its average Zacks price target. And it's now down about 8% overall in 2023, even though, as we said, the market's up over 22%. So looking at some technical levels, it's trading above its 50-month moving average. And despite trading above that 50-month moving average still, it's at some of its most oversold RSI levels over the last 15 years. And then looking more less long-term, it just found some buyers at its 200-week moving average, which is a positive sign for Pepsi. So that's catching some buyers recently. And then it's also trading now above its 50-day moving average as well, which is another good sign. And then on the valuation front, it's trading 22% below its highs at 20.5 times forward 12-month earnings, which is also below its decade-long median and right in line with Coca-Cola. And this comes despite the fact that Pepsi's up 100% over the last 10 years and Coke's only up 42%. So overall, Pepsi, as I said, lands a Zacks rank number 2 buy, and its beverages / soft drinks industry is in the top 8% of over 250 Zacks industries. So Pepsi, along with NextEra Energy, is certainly worth considering heading into 2024 as more industries outside and more sectors outside of large cap tech start to have more investors' attention. So it's certainly worth taking a look at both of these S&P 500 giants of key industries that aren't going out of style, and maybe they're going to come back in favor sometime soon to consider buying these 2 stocks heading into 2024. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.